Today we are joined by Franklin McLarty of RML Automotive and Jason Fox of WP Carey. Gentlemen, welcome to the program today. Thanks for being here.
Yeah, thanks for having us.
Thank you, David.
We're talking about something that should be of great interest to people in the automotive retail sector, people who own car dealerships, and that is the financial challenges that many of these businesses often face in growing. And so both of you have know a lot about those challenges and also have structured a solution, so I'm fascinated to hear about that today. And so maybe starting with a question for Franklin, your business is the automotive retail sector, and you've built a business and you continue to grow a business in that sector. So I'm interested in maybe an overview that you could paint for us of the kinds of challenges that these kinds of businesses face in growing.
Well, David, again, thank you for having us here today. Our family's been in the car business for almost 100 years, so we've watched the evolution of the dealer network. And all of the OEMs, the original equipment manufacturers, rely on the dealer network to actually transact with the public. And so in today's landscape, you've got a variety of competing factors, but it's become a very capital-intensive business, and that's clearly one of the pressures that dealers face out there. And the real estate component is a significant capital expenditure for automotive dealers nationwide, and our partnership with WP Carey has allowed us to meet that with the flexibility we need.
And you two actually did a couple of transactions that we're going to hear about in a bit, but more generally, Jason, can you talk about the attributes of many automotive retail businesses, I guess from a real estate perspective, that are attractive to W. Carey and fit into its strategy?
I mean, for us, when we look at transactions, I mean, we're mainly focused on a number of factors. One is the credit behind our tenant. We're certainly looking at the criticality of the real estate itself, and then the underlying fundamental value of the real estate. And I think this industry, you know, for many reasons, and some of them I think they're misconceptions, is a highly cyclical industry. And that's certainly true on the new car side. And the manufacturers like Ford and Chrysler, they go through some pretty big swings in production. However, in the dealership space, what we found is that it's much more stable than one would think. New cars do go up and down quite a bit, but during those counter cycles, you have used car sales that increase significantly. And then throughout the term, and even more so in a down cycle, you'll have parts and service, which are really a mainstay of the dealership operation. So for us, we see this stable cash flowing component of the business, and where parts and service cover, I think, 70% of the fixed costs of the average dealership. So it does have some stability that you wouldn't typically see, and that's important from us from an underwriting perspective. We also see it as a good opportunity. There are not many, really any institutional investors that are currently targeting this with a well-capitalized balance sheet. And so we feel that there is an opportunity to come in with W. Carey's ability to raise capital and offer sale-leasebacks, and offer sale-leasebacks that include an expansion component or an upgrade of the facility, and also to provide acquisition financing for new purchases for some of these dealerships.
Well, let's get back to the RML story. Can you talk about, Franklin, the circumstances that your business was in that led you to seek a financial solution, and sort of how you structured a deal with WP Carey?
Certainly, David. As we grew, and we grew quite rapidly, we're one of the top 20 largest dealers in the nation as of now, and are less than 10 years old. So our family partnered with Bob Johnson and his team at RLJ Companies, and began to take advantage of some of the distress in the market through a lot of acquisitive activity. Wanted to continue to grow, and we're looking for the best return on our equity investment. And the return we get on our operational investments versus the real estate, there's a substantial difference between the two. So to be able to find a good long-term real estate investor who's going to be a good, flexible landlord, where you have long-term clarity in who that landlord's going to be and how they're going to behave, allows us to invest our dollars where they're most accretive.
And I think that's an important part of what WP Carey has to offer. I think one is we do have a long history of owning assets for the duration of the lease term. So as Franklin looks for flexibility, whether it's in lease consents or working with a floor plan financing lender that needs some cooperation from the owner itself, that's something that we've been around, and you know who your landlord is. There's a relationship that has developed. I think more importantly, we've been well capitalized for a long period of time, and one of the things that we like to do is put further money into our investments, which can help us extend lease terms, and really that's our business. We don't want to have to be in the re-tenanting business. We want a tenant that's going to have some long-standing history at this property, and by continuing to reinvest in that property and extend leases, we can have that and have some more continuity.
Now, you've done so far 2 transactions in the automotive retail space. Just briefly, can you walk us through what they were and what the the main characteristics were of the structure.
Sure. The first transaction was a sale-leaseback we did with RML here with Franklin helping lead the charge. It was a sale-leaseback of 8 dealerships located in several states, again diversified across across brands with Mercedes and Ford and Chrysler and Nissan and Toyota, as well as some others in multiple states. And for Franklin, and Franklin can speak to it, it gave them an opportunity to really consolidate their landlord relationships. Instead of dealing with a number of owners, and each individual owner had several partners, they're able to deal with one landlord whose business was to own this real estate and whose business is to communicate and maintain a partnership with the tenant.
Well, Jason's absolutely right. Oftentimes in a transaction, we'll go in, we'll acquire a dealership from someone, and for whatever reason they decide they want the passive income of being a landlord. That's usually fine, but sometimes things change in their landscape. They may have some health issues and other family members get involved, and it's not a very professional relationship and can become complicated. And what we really want to focus our attention on and our corporate resources on are operating the business, not complicated real estate negotiations. So to have one institutional landlord whose interest is purely aligned to be a long-term triple net lease landlord gives us the clarity and certainty we need to be aggressive in growing our business, whether that's through improving operations or acquisitions.
And the second transaction we've done with them is a little bit different scenario in which we're helping them finance a new acquisition. They had targeted a North Dallas as a location they wanted to be in, and opportunistically there was a Toyota franchise available. And we've separated the real estate from the operations. We're coming in at close to buy the real estate and lease it to RML on a long-term net lease basis. RML and their owners are coming in to buy the operations or the blue sky. And in the end, we get what we want, which is a long-term lease with a very credit-worthy tenant. They're providing stable income for our investors, and Franklin has his money tied up in the operations where they can really get the type of returns that they're looking for.
Since you guys know a lot about the real estate landscape in the automotive retail world, I have a question. How often is it that the automotive dealers themselves own the land, own the property from which they operate? Is it significant?
It is significant, although there's a little divergence between the owners of the operation and the owners of the real estate. So they're related, but not necessarily in the same nuclear family, to use a metaphor. Oftentimes you'll have a very strong operator who's built a long-standing track record in the industry. They may have 10 or 15% ownership in the operations, and then they're backed by an institutional sponsor, a high net worth individual, and that high net worth individual has traditionally owned the real estate. The challenge with that is you end up with potentially conflict between the ownership group of the operations, since one is on both sides, the real estate and the OpCo, where the other is only on the operational side. And so we like the alignment it gives our operators, who usually have some equity participation in the day-to-day operation, by having an institutional third-party landlord.
So Jason, W.P. Carey has done 2 transactions so far. Sounds like you remain interested in this automotive retail sector. Are you still prowling for new deals?
Oh, absolutely. I think this industry meets a lot of the things that we look for in a long-term net lease. When we look at transactions, the creditworthy of the tenant is very important. Obviously, that's going to vary on a deal-by-deal basis. But more importantly, the criticality, which is also a key component of our underwriting, is very apparent in this industry. The real estate is the operations in many cases, and so it really fits the mold. And I think lastly, we have raised a lot of money. We have opportunities to put into different industries, and given the lack of institutional capital focused on owning real estate in the automotive market, we think there's opportunities to really find ways to invest money at good yields. A sale-leaseback transaction is a transaction in which an owner-user of real estate sells its real estate to an investor such as W.P. Carey, and in turn leases the real estate back under a long-term triple net lease. They retain ownership responsibilities of the property, which include paying the taxes, maintenance, and insurance.